Okay, wonderful. Welcome to the personal finance series for Cutco managers about demystifying taxes. And I know those of you on the call, I believe, know who I am. But for those of you on the recording, my name is Cassie Adeshino. I am a former Cutco rep, branch, district pilot. I've done most things there are to do in Cutco. My sister actually also worked in Cutco for the region office. So I've certainly been around the Cutco world for a long time. And for the last 7 years, I've been working with Adam Stock and the Next Level Planning Group, which is separate from Rising Stock and My Books Pro, but we help individuals, families, and business owners make optimal decisions with their finances. And the reason why I'm here is because as a younger college grad, owning my own business, making decisions, I knew nothing about finances. There was nothing that prepared me to make great decisions about finances until I joined our team. And I started learning, studying. I earned my certified financial planning designation. And I feel like I've been blessed with a gift of knowledge. And certainly there's more to know, but I wish I knew then what I know now. And I care deeply about sharing what I know now with people that are just starting out, with people that are in the shoes that I was not that many years ago. So that's why I'm here. I want to help people make great financial decisions. And there's no education system that helps support that. So I'm glad you're here today learning about taxes. And we're going to be talking about demystifying taxes. So that's one thing that we all have to do. We all have to focus on, but most people really just don't get it. So we are going to jump right in. I'm going to share my screen. Okay. Can you guys see my screen? Perfect. So objectives for today are helping you understand what goes into the 1040. So we're going to be spending a lot of time going through each line of what the 1040 is, and that's the form that we all fill out to file our taxes. I'll give you some steps and takeaways towards healthy tax hygiene. There's not much of a better way to put it than you got to take care of it. It's something we've all got to do. So healthy tax hygiene steps and really helping you understand how important it is to get it right and what might happen if you don't. So our last call, we started with a financial maturity quiz. If you didn't have a chance to listen to the recording, I'm going to send that out to everyone after this call. Well, we talked about financial maturity is really these different characteristics. What we're going to focus today on paying tax quarterly, planning ahead for taxes, but this is just part of the journey of financial maturity. Some of you may be right there with some of these items, some of you might not be, and maybe that's why you're here on the call today. But this is one of the characteristics that everyone needs to work on. So let's go ahead and jump into the anatomy of a 1040. Everything you ever wanted to know about the 1040, starting with the very top. Filing status. This one's pretty simple. You just check a box. And this is going to say what is the tax rate that I'm going to be put through at the checkout line when I get there. So if you're single, you pay a different tax rate than if you're married for the same dollar amount. So this is an important one to get right. Most people fall into the box of single or married filing jointly. One of the largest portions of the tax return now is your information. This one's pretty easy. I will rewind here a little bit. Back in 2017, Trump declared that most Americans are going to be able to file their taxes on a postcard. And this is the shorter version. This is a shorter version of the 1040 than it was before 2018, after the Tax Cuts and Jobs Act was filed. But unfortunately, you don't fall into the category of most people because you own a business, which means that there's going to be schedules and worksheets and a bunch of additional paperwork that you get to file with this shortened version of the 1040. So we're going to go over all of that today. What are the schedules? Where does it go? Which line goes where? And what does that all mean? And then afterwards, we'll talk about what you can do about these numbers. So the biggest portion of the tax return is going to be your information, the new version. Standard deduction, this is going to, so if your parents perhaps still claim you as a dependent, that's really important to know. If you're filing your own taxes, it's likely that they don't, but it's important to know. If you were born before January 2nd, 1955, or are blind, or your spouse is in that category, you get an additional standard deduction. If you and your spouse don't file the same tax return, your standard deduction is going to change. So it's important that you select the right option for the standard deduction. Okay, dependents. If you have children, these are the most common dependents. Some people have other family members that live with them that they provide care for that may qualify as dependents. For example, my nephew lived with us for about 6 months, and we paid for all of his expenses. So he was a dependent of ours. But most people are going to put their kids on here. And you'll notice that in section 4, there is a child tax credit. So this replaced what was personal exemptions. So back before 2018, every person in your household got a personal exemption, and that reduced your taxable income. But now there's something called a child tax credit. For any child under 16 by the end of the year, you get a $2,000 tax credit. Now, some people get a little bit confused when we talk about credits versus deductions. So let's go through a little bit of a worksheet on that. So credits, an example, let's say you have $100,000 of income, taxable income, that gets passed through the 20% tax rate. Let's just assume you're at 20% blended tax rate. You pay your tax is going to be $20,000. Your tax credit then comes off of your tax due so that you only pay $18,000. If you have deductions, so this could be, let's say you have $2,000 of deductions. This could be business expenses or deductions. This could be student loan interest is deductions. This could be mortgage interest, real estate taxes, lots of deductions, which we'll get into a little bit later. That comes out before your income is passed through the tax rate, through the checkout line. So we have $98,000 then gets passed through so that our tax paid is $19,600. So which do you prefer, a credit or a deduction, right? The credit is a dollar for dollar reduction in taxes. Deductions are only reducing your income by whatever your tax rate is. So in this case, that would be 20%. You save $400 by taking that deduction. So credits go here, child tax credits. If you have a lot of kids, Adam Stock, you all know him. He's got 5 kids. He actually has to check this box up here because he has more than 4 dependents. And he gets a child tax credit for all of them because they're all under 16. Okay, next we have wages, salaries, tips, etc. If you are not incorporated and you're single and you only earn money through your income with Cutco, you would not put anything here. This is only for W-2 wages. Only for W-2 wages. If you are incorporated and you take a salary, you're going to get issued a W-2 at the end of the year, and this is what goes there. This is only W-2 income. Tax exempt interest. So questions 2 and 3 are from income, and this is really from taxable income. So if you have like a Robinhood account or a taxable brokerage account, this is not talking about retirement accounts like Roth IRAs or SEP IRAs or 401ks. This is only in taxable investment accounts. So tax exempt interest is interest from municipal bonds, which is mostly not taxable at the federal level. You may have some bonds that have taxable interest, in which case you get a 1099 at the end of the year, and it tells you how much to put here. Qualified dividends are dividends from stocks, specific stocks or mutual funds that you don't pay income tax rates on. You might have, maybe you only pay 10 or 15% on qualified dividends or ordinary dividends. And all of these, here's our first schedule, Schedule B. All of these are put into Schedule B, which are then flowed through into questions 2 and 3. So again, this only applies if you've got a taxable account. You get the 1099 and it shows you what to put in these boxes. 4 and 5 refer to, for most people, this is going to be retirement income. So IRA distributions, pensions, annuities, and Social Security benefits. And the reason why there's two sections here, right? We've got the first section, which shows the amount that you put out. And the second section shows the actual taxable amounts. So not everything will be taxable. For example, for IRA distributions, you might be doing backdoor Roth IRAs, which is kind of an advanced thing that we do for some of our clients. But you wouldn't pay any tax on that because of the type of conversion that you're doing. You may only pay 50% tax or 85% tax on your Social Security benefits. So this is more for people that are in retirement, but it's important to know that's where it goes. So you might have zeros for those if you're not retired. Section 6 is capital gains or losses. So just to back up a second, tax exempt interest and qualified dividends and the taxable interest and ordinary dividends, this all can take place without buying or selling anything. So you might buy stocks and hold them, or buy mutual funds and hold them in that Robinhood account or that taxable brokerage account. You're going to get a 1099 at the end of the year anyways. Capital gains or losses is in those same types of accounts or other investments that you might have. But for most people, it's going to be buying and selling stocks or buying and selling mutual funds and how much of a capital gain or loss you have. And that is all reported on Schedule D, another Schedule D. So again, if you have a Robinhood account, you're buying and selling stocks, having fun with it, you will pay tax on any gains that you have. And this is where that gets reported. 7 and 8 is other income. This is all reported on Schedule 1. So other income and adjustments to income. So Schedule 1 is going to condense both of these things, which is kind of a lot. So let's take it one by one. So we're going to take all of our additional income, that's on line 9, which we'll go to in the next slide, and then all of our adjustments to income, those get put into 7B and 8B. So this is what Schedule 1 looks like. And by the way, I'm using 2019 here because the 2020 forms, the only versions I could get say draft right across the end because it's not 2021 yet. You can't file these taxes yet. So if you're wondering why it says 2019, that's why. But the forms are essentially the same. Okay, so we've got additional income, which is where your income comes in, right? This is where all the fun happens. And line 9 we just went through. That combines all of your additions to income. Section 2 is adjustments to income, and we'll take this apart piece by piece in just a minute. And then we've got line 22. We put that back onto the 1040. Okay, so if you are not incorporated, so you don't have an LLC, or you have an LLC and you file as a sole proprietor, or if you just aren't incorporated at all, this is where you file. This is where you figure out what is my profit, and you put it on Schedule C. So it's calculated on Schedule C. The answer to the equation goes on line 3. If you are incorporated, you're going to fill out Schedule E. This is really simplified taxes, isn't it? So if you are incorporated, you have an LLC, you probably file as an S Corp. We could have a whole nother webinar on just which way to file and what all that means, but it's likely that you file as an S Corp. So if you have an LLC, this is probably the one that you'll use. And your income is reported on a K1, and you fill out Schedule E. And this is where if you also have rental real estate, you can see that all goes onto Schedule E, and your net profit or loss is reported here. So I thought I'd include just an excerpt from Schedule C because I wanted to touch on the business expenses piece here again. Business expenses, if you're a Rising Stock client, which many of you are, or you track your expenses, this is why. This is why you track your expenses, so that you can get these deductions on your taxes. So I underlined the main ones that I know Cutco people use. You've got your advertising, which is not as much as it used to be. When I actually found out from an ad in the newspaper, back when people read newspapers, and people put ads in the YouTube, Trent? Yes. My mom circled it one morning and then I called.
It was in like 1993. Yeah.
Love it. Worked well in 2007 too. Insurance, so business insurance goes here. Office expenses, if you contribute to a SEP IRA or the profit sharing portion of a 401k, that is a business expense, which is different than the employee portion of the 401k. Any supplies, travel is a big one that many people will deduct. Meals and entertainment. So here you see it just says meals because entertainment's very difficult to get an expense for after the Tax Cuts and Jobs Act was passed. And anywhere you see where it says see instructions, that means there are rules around the deductibility of those expenses. And for meals, you only get a 50% deduction. So it's important to know that when you're thinking about spending money on your business, and thinking of it as like, oh, it's a tax write-off. It's not all going to reduce your taxes dollar for dollar. It's not a tax credit, right? So let's look at this for just a second. Business expenses reduce your reportable taxable income, right? We put it on Schedule C and we take what the net number is based on the rules. So some business deductions reduce your income by 100%. Meals, for example, reduced by 50%. There are some entertainment expenses that are allowable, not as many as it used to be, and it's only a 50% deduction. Personal deductions are reported as adjustments to income, which we just saw in Schedule 1, or itemized deductions, which we'll go over in a few minutes. And those are reported on Schedule A. Now, they all work the same way. They're all deductions. And if you have $100 that you were thinking, hey, you know what? It's a business expense. It's a tax write-off. I'll just buy it, right? $100. Well, it may have only saved you $20 in tax, right? If you're at a 20% tax bracket. So you have $100 less in your bank account, whereas you would have only had $20 less, right? So you would still have $80 in your bank account had you not bought that thing. So I want you to be smart business people making smart business decisions, not decisions based on, oh, I want this, I could write it off, right? That's not how it works. Okay, so let's go back to adjustments to income. Adjustments to income are the most common ones that you're going to be using are the health savings account. We talked about this in other webinars. Health savings account, reduce your taxable income. You have to qualify, so you have to have a high deductible health insurance plan, and it has to be HSA eligible. So if you aren't sure, you can contact your health insurance company. Let's see, SEP IRAs, and if it's not reported on your Schedule C, you can report that here. You can use the self-employed health insurance deduction, so you can reduce the premiums that you're paying for health insurance. And if you're paying student loan payments, then you can deduct the loan interest up to $1,500. So those are the more common ones. And then we take those and we put them back to the 1040. And that brings us to the standard deduction, which is going to be Schedule A, another schedule. So the standard deduction is a choice. So in order to take a deduction in line 9, we have to determine whether or not we're going to itemize, which I guess people used to say like the long form of the taxes, or take the standard deduction. And we're going to take whatever is higher in this case. So at a minimum, we are going to take, if we're single, $12,400, and we're going to take that off of our income. Or if we're married, $24,800 comes off the income. So this is a big benefit for people that don't own homes, college grads, maybe people that just really aren't interested in owning a home. That's what the standard deduction was made for, people that don't have that many expenses yet. So what Schedule A does is it adds up all of the things that might go above the standard deduction. And there's only certain things that qualify. And the biggest things, there are more than this, but these are just the biggest things I wanted to touch on, is mortgage interest, real estate taxes, State income taxes, which those two are limited to $10,000. This is new as of the Tax Cuts and Jobs Act of 2017. So it doesn't matter if you're married or single, the limit is 10,000. If you file separately, the limit is 5,000, by the way. And charitable contributions. So these are the four big ones that allow you to itemize your deductions. So the hurdle to be able to itemize is, again, the standard deduction. So let's look at a simple example here of someone who's single. The standard deduction hurdle is $12,400. Let's say they pay real estate taxes, mortgage interest, and they give some money to charity. So if their real estate taxes are $3,000, maybe they pay $7,000 in mortgage interest. Right? This is a starter home for those of you that pay really high real estate taxes. In order to itemize their deductions, they're going to have to give $2,400 before any other dollar of charity is going to allow them to itemize. Does that make sense? So if they give $5,000 to charity, they would itemize. If they give a little bit less, then I know this isn't the reason why everyone gives to charity, but those dollars wouldn't make a difference in tax terms.
So if the donation amount was like $10,000, then obviously you're going the itemized route.
That's exactly right. And there are some strategies that we can employ if you do give money to charity every year and you're close to that threshold of itemizing or not itemizing. There's some strategies we can employ to really make a big bang for your buck when you're giving to charity and potentially give more to charity than you otherwise would have. So we decide standard deduction or itemized, we put that into 8B, and then we get to take a qualified business income deduction. This is new as of 2 years ago. So this is another thing that was passed with the Tax Cuts and Jobs Act of 2017. Qualified business income, I'm going to let your accountant determine that because every accountant I've spoke to said it's something else. But let's say your qualified business income is 20 grand. You get to deduct 20% of that $20,000. So you would get to take off another $4,000 from your income with this deduction. If you are in the high earning echelons, if you're in like the 300,000 or 400,000, there are some phase outs and there are some actual disqualifications when you get into those high income brackets. But for most people, they get to write off 20% of their qualified business income, which is a really big deal. So this is really, for business owners, this was one of the biggest savings of the Tax Cuts and Jobs Act. And then we figure out what is our taxable income. So we just take the difference. Here's what we earned. Here's all of our different deductions. We get our taxable income, which then runs through the tax brackets. So these different forms are where we calculate that. I'm going to use a screenshot here to show you just the two most common tax brackets, individuals and married filing jointly. And you can see the married filing jointly is just a little bit more than, it's double in most cases for what the thresholds are. And these are for 2020 numbers. So let's go through an example of how this works because there is quite a few misconceptions about how the tax brackets actually work. So let's say we take our taxable income from our 1040 and it's $94,200. And that would mean that we're above the $85,000 range. We're going to take $14,605 because everything under $9,875 gets taxed at 10%. Everything between that and $40,125 gets taxed at 12%. Everything under $85,525 gets taxed at 22%. You see where I'm going here? So every increment gets taxed at its own tax rate. So if you make $86,000, only the amount over 85 gets taxed at 24%. So we're going to pay the $14,605 plus 24% of the amount over the $85,525. So that's $2,082. So we pay a total tax of $16,687. If we take that divided by our total income, or taxable income, that means the tax rate that we're paying is 17.7%. So there's two terms that you hear when you talk about tax rates. There's the marginal tax rate, which is if you earn another dollar, that's what your next dollar is going to be taxed at, which in this case is 24%. And the effective tax rate, which in this case is 17.7%. Now remember that this is just federal taxes. This does not include state taxes. Okay, so what other taxes do we have to pay? We have to pay self-employment tax. Self-employment tax, this is a fun one. Self-employment tax is also known as payroll tax, also known as FICA tax. And as a business owner, you pay two parts for the employee and the employer. Social Security, you pay 6.2% for each. Now there is a top, right? There is a wage base that is taxed. So anything over 137,700. So if you earn 140,000, those extra $3,000, $2,300 don't get taxed for Social Security, but everything else does. Medicare has no limit, and that's 1.45% on everything for both the employee and the employer. So 7.65% each is 15.3% total. But don't worry, you get a deduction for half of it, which doesn't end up being much of a deduction at all. A couple hundred to maybe a couple $1,000s in a deduction. But this is a big deal. And when people talk about incorporating, this is why many people incorporate. If you have $100,000 of taxable income and you don't incorporate and separate between a W-2 and what's called distributions, all of that $100,000 is subject to 15.3%. If you pay half of that as a salary, only $50,000 gets taxed at 15.3%. Now, there are some impacts to the qualified business income when you incorporate and do a salary versus everything. So more than ever, it's really important to get a CPA involved. I'm not a CPA, so really important to get a CPA involved to help you determine whether or not you should incorporate or not. Okay, so that's the self-employment tax. You're going to add that to the tax rate, the federal tax rate, and that is going to be your total tax. You're going to subtract out what you've already paid. So if you are making quarterly estimates, if you do have a W-2 and you have withholdings come out, that goes here. You take out whatever you've paid already, and you get to add back in your credits. So if you have 2 kids, you can put $2,000 in here. There are other credits for education credits that you may or may not qualify for. You can talk to an accountant about that. And then you figure out what is the additional tax that you owe or what your refund is at this point. And that is the anatomy of a 1040. And a good point for me to stop and take a breath. For those of you that are on the call, any questions about the 1040?
No, this is really helpful, Cassie. Comprehensive, and yet, I mean, you managed to take what is a scary form to look at, and as you advertise, debunk it, so it's not frightening anymore. It's good, great.
Yeah, Cassie, I would just chime in and say, just really great walkthrough. And, I wish I had this kind of walkthrough when I was a new manager, because like Trent said, this can just be so intimidating to look at. I think that we have some people that probably get into the situation where they're so intimidated by it that they just shelf it. And that is the not a great plan when it comes to taxes and to push it off and push it off. And so certainly it's a great testimony to make sure you're working with a professional on this stuff, both on the tax side of things and also on the financial planning side of things, so that you can put different investments and things in place to to mitigate taxes the best possible. So yeah, great stuff. And this is an awesome walkthrough. We will get a ton of great use out of the recording for sure.
Nice. Yeah. And I'll touch on the a few ways that we can reduce the taxes and also what the penalties actually are for not paying. So thanks for bringing that up, Wes. Michael, did you have a question?
I did not. I just wanted to say thank you for your time.
Yeah, I'm not done yet. This was just a little break check-in.
Okay, I
So
wasn't sure.
stay tuned. Yeah. Stay tuned. Okay, great. So let's move on then to talk about what you can do about taxes and just a few next steps to take. If you are new to this and you're not sure, what to do next, let's talk through that. So the first thing you can do is lower your taxes, right? Don't pay more than you have to. I kind of minimize the impact of deductions before when we're comparing it to credits. But if you have to pay for something, if you have to put money somewhere, you have extra money to save, you might as well get deductions, putting it in certain places. So like Wes was saying, putting money in tax vehicles that can help save on taxes, right? You can contribute to HSA and retirement accounts. And you can see right where it gets deducted, right where it reduces your income. You can contribute to, if you've got, maybe a few $1,000s, a SEP IRA is a great place to put your money. If you've got $20,000 plus to do something with, you can put money into a single 401k. There are 401ks you can open just for you, where you can put aside $19,500 that will reduce your taxable income. Plus, you can do a profit sharing contribution, which is about 20% of what your profit is. So there's lots of ways that you can reduce those numbers. And if there's certain thresholds that you're trying to get under to qualify for maybe a Roth contribution, or maybe if you're really close to that $300,000 mark for the qualified business income deduction, those are great places where you can reduce those limits. HSA accounts, they reduce your taxable income. And if you use that money for qualified medical expenses, you don't ever pay tax on that money. That's the easiest money to earn, right? You have to work less for that money because you don't pay any tax on it. Okay, so that's the first thing you can do is lower your taxes. Second, use vector tax withholdings. You have to pay tax, right? You're going to have to do it. And most people, because we aren't like taught to do this, right? There's nothing that really prepared us as individuals coming into the workforce. Most people who are employees of companies are forced. Without a qualified exemption, you must withhold money from your W-2 if you're an employee. Vector withholdings is your way to force yourself to do this. I recommend between 25 and 30% because again, we're not just talking about federal tax rates. You have to pay the self-employment tax and you also have to pay state taxes. If you live in a state like California, you're going to pay like 9, 10, 11% in state taxes. So know your state tax rate, figure out what's right for you. So somewhere between 20 and 30% is probably the right rate for you. But use it because it's automatic. It pulls out before you can even think about it. Hire an accountant. I really strongly encourage you. I think it was my second branch summer that I hired an accountant. And it was the best decision I ever made. I remember like going on TurboTax, like trying to figure it out with all my business deductions and my receipts and everything. Hiring an accountant and Rising Stock, those were probably my two best financial decisions when I was a manager. But work with an accountant, someone who is at least a CPA. You want to try to get someone who's a tax strategist, somebody who really will help you not just take orders and take information and record it on your tax return, but somebody who might tell you like, hey, you might want to consider this or might want to consider that because they can really help. So hire an accountant, talk to maybe a district manager, maybe your parents' accountant is someone you want to work with, or talk with other people you trust to get referrals in your area for someone to work with. Definitely worth their money. Start paying quarterly estimates. If you don't do this already, strongly encourage you. Your accountant will tell you to do it. But pay quarterly estimates. If you don't have an accountant, you can still do it. You can still do it on your own. If you don't even know where to start, whatever you paid last year in taxes, divide it by 4 and pay that. Unless your income is going to be much lower this year, at least start there. How to do it? So easy. You can do it right online, irs.gov/payments, bookmark it, save it, on your phone, whatever you need to do. Check your state's website as well, because most states allow you to pay online. You can also write checks if people do that still, you can write checks. But you can do debit card or direct pay. Only do a credit card if you listen to my first webinar or second webinar. Only do a credit card if you're going to pay that off right away. Don't rack up credit card debt with tax payments. There are other options unless it's interest free. So that's how you pay quarterly estimates, and then you just pay it. Your accountant might tell you what the number is, or again, if you're not working with an accountant yet, you just take what you paid last year and divide it by 4. Quarterly estimate due dates. So they're like 1 month removed, right? So April 15th is the first quarter, and they're not all like the same. So June 15th is second quarter. Take a screenshot of this if you need to. Third quarter, September 15th. Fourth quarter is January 15th. Mark this in your calendar. It's the same every year. Recurring events, notifications on your phone, right? This is maybe a week before, this is when it's due. Know when they're due and plan ahead for them. Right? This is the next step of financial maturity, planning ahead for these things. Okay. Next, I want to talk about like the weightiness of getting this right. I think it was Wes that said, like, for some people, looking at that 1040 is overwhelming and can cause people to ignore instead of face it. And I just want to let you know that it's really, really important that you get it right. So you probably know that there are penalties. There are actual financial penalties for not paying your taxes. There's a failure to file penalty, which is 5% up to 5 months. So if you owe $5,000, then you could owe up to $1,250 in penalties if you don't pay for 5 months. And there's also a failure to pay penalty, which is depending on if you have a payment plan already in place or how far behind you are in taxes. So the penalty actually ranges, but it's up to 25% of the unpaid balance. And then there's also a failure to pay proper estimated tax penalties. For most people, it's going to come out to a couple $100, but I don't know about you, but I'd rather have a couple $100 than give it to the IRS. So pay your estimated taxes. And there's one on here that I didn't put in the slide, but there's an emotional penalty as well. There's a weightiness to knowing like I'm behind, I'm not getting this right. All right. A shame, embarrassment, like that can really weigh on people, stress people out, give them anxiety, and it's not something you need to deal with. And if you continually ignore your taxes, the IRS can make you forfeit your refund, file charges against you, they can revoke your passport, they can lay a claim against your property, and they can actually seize your property. So there are some serious and significant penalties that come with taxes. And there are also payment options. So this is, I wouldn't say a last resort, but this is like a second to last resort is payment options. If you can't pay your taxes, maybe you can talk to someone about borrowing money, but really avoid interest rates here. Okay, so I would say it's second to last because this is better than putting it on a credit card where you're charged 20, 21, 25% interest. If you have an interest-free credit card that you can apply for and pay that off in a year, use that. Or maybe you can get an 18-month or 21-month interest-free period. But this is how you do it. So Form 9465, the interest is the federal funds rate, which is usually somewhere around 2 or 3%, plus, that shouldn't be equals, it should be plus 3%. I apologize for that. And it's charged on whatever the balance is plus the penalties. Usually they're 72 months or less, and those penalties and the interest accrue until it's paid off. So I just wanted you to know how it works, that it was an option, and it's an option to use before a high interest credit card. But maybe there's some people you can talk to about it beforehand. So just to give you a sense, right? I think examples are really helpful. So if Fred files his taxes for 2019, he owed $7,000. He wasn't able to pay all that, so he set up a payment plan. And if the federal funds rate is 3%, he's going to pay a 6% interest rate on whatever the outstanding balance is. He's also going to have a failure to file penalty and the failure to pay penalty on whatever the outstanding balance is. So 6% annually on penalties. So he ends up, after the 3 years, pays $840 in penalties, plus the $7,000 that he owes. So again, it's really important that you get it right. You don't want to pay the extra amount in penalties, and you certainly don't want to rack up a bunch of debt elsewhere to pay your taxes. So plan ahead, use vector withholdings, get an accountant, pay your quarterly estimates, talk to someone about opening up retirement accounts if that's the right thing for you. It may be that the Roth IRA is the best thing for you and not getting the tax deduction is the right call. So talk to someone to make sure, to do that calculation for you and contribute to an HSA. And write down your takeaways from today. I'd love to hear, for those of you on the call, what were the biggest takeaways so far?
For me, a big takeaway was using tax withholdings. So currently I'm doing 10%. So expanding it to 20 to 30% minimum.
Yeah.
Just to clarify there, Michael, 10% of your income or 10% of your total vector commissions?
I believe it's income. So just tax withholdings that I receive weekly.
Yeah, so Michael, I think what Trent was talking about there is that you don't necessarily have to save 30% of your total income, but
Okay.
30% of your profit. Does that make sense?
Yeah, that makes
So it
sense.
might end up being that 10% of total income is plenty for you. Thank you for making that.
Thanks, Trent.
No problem. You might be good, in other words, right? But
Yeah.
if you're going to make a mistake, there's a takeaway. You don't want to be light. It's your money, but if you're going to make a mistake, maybe bump it to 12, And then once after you've got a couple of years, you start to get a sense of this. But engaging with, one of the ways I like to describe that financial partner, I love the way that Cassie was explaining that CPA, not just somebody that takes what you're giving them or asking a few cursory questions, but somebody that's going to be a chief financial officer for you in your business, right? So somebody that can, help you navigate those choppy waters and help you plan. And as you plan to make more money, it starts to go, all right, say next year we're going to want to start thinking about this. And somebody you've got a good rapport with and don't feel stupid around. Like somebody you've got a rapport with. Keep in mind, they work for you, right? And what I love about some of the stuff that we see here at Rising Stock and here with Cassie is that they can celebrate this stuff with you, right? You don't have to be an expert in this stuff. Dude, if your car breaks down, you're not freaking out about the fact you can't change the brakes or something like that. The professionals do that, right? So, but what you do have to do is when the light goes on, you got to take the car in. So in this case, taxes are a thing, and we've just got to make sure we've got professionals that are there to protect us and to make sure we're keeping them as much of our money as we can.
That's right.
Yeah, I would just chime in and just, piggyback on what Trent just said, just the opportunity cost of spending your time not only worried and stressed about gathering up all the details for deductions and all of this at the end of the year, but the emotional stress that Cassie was talking about earlier, your time, effort, and energy, by delegating that to a professional and you spending more time on recruiting, training, developing sales, that is going to be a win in the that's going to be a notch in the win column every time, when it comes to that. And that then, when you say what was your biggest takeaway, even just going through the form, there's things that I learned from that because I delegated that from a very young age and outsourced that. So I even learn something, even from going through that. So I appreciate you walking through it, but I'm happy that I don't need to know it. Because, you know, I think it's so important to have a good bench, as we say, and to continually be looking at your professional bench and how are you being served, and what can you do to make sure that you're learning alongside, as you're as these people are doing work on your behalf.
Absolutely. And some people that are on the call or listening to the recording, this might, cause some more anxiety or some stress because you might feel behind. And I hope that you just sit with that, maybe nervousness or anxiety. If that's you, sit with it for a moment and don't suppress that. Let it move you into action instead of, cause you to, kind of go back into your shell. I'd rather you wake up now and get a team, right? Get the bench that Wes was just talking about. I'd rather you do that now than 5 years from now when you're dealing with the penalties and working in back taxes, and that's just not fun. I've had people on payment plans for a decade that have come to me, and there's nothing good that comes from not paying taxes. There just isn't. So let whatever anxiety or nervousness that you have, let that move you and catapult you into action. And Wes, that was actually a good segue to this next, the last piece here, which I want to touch on, something that I'm offering. After these webinars, some of you may still have some questions. I couldn't possibly cover everything there is to know about personal finance on 3-hour-long webinars. And some of you may not know where to go next. Maybe you still have some questions about your situation. Maybe, you just want to make the right moves and you want some confirmation, or maybe you're really embarrassed and you don't want to ask someone, or maybe you're ashamed of your situation and you just are kind of isolating around that. The truth is that most people who will seek you out as a new district manager or as a young person, they want to sell you something. They're Northwestern Mutual agents or they're New York Life agents. They want to sell you insurance or financial products. And most of you, that are district managers or are new to this probably don't need those. And I want to give more people access to sound advice without a sales pitch. Just truly, if you feel like you need to get some advice and just make an action plan. You don't need to buy anything. You don't have a lot of money to invest. This is what these calls are for. They are completely confidential. There's no judgment. They're really meant to address your top 3 to 5 financial goals and questions and put an action plan together. And I'm charging $250 for 60 minutes. I think it's well worth that while. And if you don't think so, I'm happy to give you your money back. This is really for those people who just want to take some next steps and get advice. So,
well, Cassie, I want to thank you for the friends and family discount there, because that is a very good value. We know that you can command a lot more than that on the open market. So thank you for your love letter to Vector there. Folks, if you're wondering, should I try and do it? Just do it. Just try it out and tell me it's not the best $250 you invested ever. So thank you, Cassie, for being an advocate for financial wellness and health in our business and tax hygiene. What a great concept here. So I'm hoping people are smart and take you up on that immediately.
Yeah, thanks, Trent. And truly, I'm not selling anything on these calls. I truly deeply care about sharing what I know with people. I want to help people make great decisions, and I know that it's hard to get access to that, and I want to. So
I can just chime in also, Cassie, and just say I've been working with Cassie and with Rising Stock for years now. I've recommended several people who are just starting to get their finances in order or just starting to make more money, and having the questions, okay, what do I do with it? And they have all raved about the coaching that they've gotten from working with Cassie specifically. So you have my highest testimonial.
Thank you, Wes. I appreciate that.
This time here was worth $250. It was free. It's crazy. Thank you.
And I will send a link. I'll put it in the chat for you, Michael, and of course Trent, available to you as well. I'll also include it in the email with the recording from today's webinar and the previous 2 webinars. So if you didn't get a chance to listen to those, you're more than welcome to click on those links and listen to them again. They can be helpful refreshers on an ongoing basis. So thank you for those of you that are here today, and for your inputs, Michael, Wes, and Trent. Really appreciate that. And let me stop my share so I can add this to the chat. All right.
Thanks, Cassie. I have to jump off into my next call here, but it's been a pleasure. I really do